It's a brisk autumn day, and you're at a vibrant farmer's market. On one side, an investor meticulously inspects each fruit, handpicking those ripe for success. This is the active investor. On the other side, a passive investor strolls casually, trusting in a pre-made basket representing the market index. Now, let's bring this analogy to finance. Join me as we explore the active versus passive investing debate, examining the pros and cons and helping you decide which strategy aligns with your financial goals. This is the Finance Virtuoso Channel, where we talk about all things finance. For your daily dose of valuable information on money, business, investments, and savings, be sure to hit the subscribe button and click the notification bell right now. Active and passive investing are two of the most common strategies that investors use to grow their wealth. But what are they, and which one is better? Let's find out. Active investing is when you try to beat the market by picking individual stocks or funds that you think will perform well. You may use various methods such as fundamental analysis, technical analysis, or market timing to identify opportunities and risks. You may also adjust your portfolio frequently, depending on the market conditions and your goals. Passive investing is when you follow the market by investing in index funds or ETFs that track a specific benchmark, such as the S&P 500 or the Dow Jones. You don't try to outperform the market, but rather match its returns. You may also diversify your portfolio across different asset classes, such as stocks, bonds, and commodities to reduce your risk. The main difference between active and passive investing is the level of involvement and cost. Active investing requires more research, skill, and time, as well as higher fees and taxes. Passive investing requires less effort, knowledge, and expense, but also offers less control and customization. So, which one is better? Well, both strategies have their advantages and disadvantages. Let's start with the advantages of active investing. Potential for higher returns. Active investing gives you the chance to beat the market and earn higher returns than the average investor. If you have a good strategy, a talented manager, or a lucky streak, you may be able to outperform the index and achieve your financial goals faster. Flexibility and customization. Active investing allows you to tailor your portfolio to your specific needs and preferences. You can choose the stocks or funds that match your risk tolerance, time horizon, and values. You can also take advantage of market trends, opportunities, and events, and adjust your portfolio accordingly. Protection and hedging. Active investing can help you protect your portfolio from market downturns and volatility. You can use various techniques such as short selling, put options, or stop loss orders to limit your losses and hedge your bets. You can also shift your portfolio to safer or more defensive assets, such as cash, bonds, or gold when the market is bearish. However, active investing also has some drawbacks that you should consider. Higher costs and taxes. Active investing can be very expensive, as you have to pay higher fees and commissions to the fund managers, brokers, and advisors who help you with your investments. You also have to pay higher taxes on your capital gains and dividends, especially if you trade frequently and hold your investments for less than a year. Higher risk and uncertainty. Active investing can be very risky as you expose yourself to more market fluctuations and potential losses. You also have to deal with more uncertainty as you never know if your strategy, manager, or stock will perform well or not. You may end up underperforming the market and losing money, even after paying higher fees and taxes. Higher stress and time. Active investing can be very stressful as you have to constantly monitor the market and your portfolio and make decisions based on incomplete or inaccurate information. You also have to spend more time and energy in researching, analyzing, and trading your investments, which may take away from other priorities and interests. Now, let's move on to the advantages of passive investing. Lower costs and taxes. Passive investing can be very cheap, as you have to pay lower fees and commissions to the fund providers, brokers, and advisors who help you with your investments. You also have to pay lower taxes on your capital gains and dividends, especially if you trade infrequently and hold your investments for more than a year. Lower risk and volatility. Passive investing can be very safe as you diversify your portfolio across different asset classes, sectors, and regions, and reduce your exposure to market fluctuations and potential losses. You also have to deal with less volatility as you follow the market and its long-term trends, rather than chasing short-term movements and events. Lower stress and time. Passive investing can be very easy as you don't have to worry about the market in your portfolio and make decisions based on simple and clear rules. You also have to spend less time and energy on researching, analyzing, and trading your investments, which may give you more peace of mind and freedom. But passive investing is not perfect either. It also has some limitations that you should be aware of. Limited returns. Passive investing limits your potential returns, as you can only match the market and not beat it. If the market is performing poorly or stagnating, you may not be able to achieve your financial goals or grow your wealth as fast as you can. Limited flexibility and customization. Passive investing limits your choices and preferences, as you have to follow the index and its composition, rather than picking your own stocks or funds. You may not be able to invest in the sectors, regions, or companies that you like or believe in. You may also miss out on some market opportunities, events, or trends that could boost your returns. Limited protection and hedging. Passive investing limits your ability to protect your portfolio from market downturns and volatility. You can't use various techniques such as short selling, put options, or stop loss orders to limit your losses and hedge your bets. You also can't shift your portfolio to safer or more defensive assets such as cash, bonds, or gold when the market is bearish. So, how can you choose the best strategy? Here are some things to consider. Your risk appetite. How much uncertainty and potential loss can you handle with your investments? If you are more risk averse, you may prefer passive investing as it offers more safety and stability. If you are more risk tolerant, you may prefer active investing as it offers more potential and excitement. Your investment horizon. How long do you intend to keep your money in the market? When do you need the money? How often do you want to access your money? If you have a longer time horizon, you may prefer passive investing, as it allows you to benefit from the power of compounding and the long-term trends of the market. If you have a shorter time horizon, you may prefer active investing, as it allows you to take advantage of the short-term movements and events of the market. Your knowledge and interest. How much do you know about investing and the market? How much do you wish to enhance your knowledge and skills? How much do you enjoy investing in the market? If you have less knowledge and interest, you may prefer passive investing as it requires less effort and skill, and more simplicity and clarity. If you have more knowledge and interest, you may prefer active investing as it requires more research and analysis and more flexibility and creativity. Finally, you may also want to consider using both strategies in your portfolio, as they can complement each other and offer you the best of both worlds. To do that, here are some tips. Use passive investing for the asset classes, sectors, or regions that are more efficient, and active investing for the ones that are less efficient. This means that you use passive investments for the markets that are more competitive, transparent, and regulated, such as the US large cap stocks, where it is harder to find undervalued or overvalued opportunities and where most active managers fail to beat the index. Then, you use active investments for the markets that are less competitive, transparent, and regulated, such as the emerging markets, where it is easier to find undervalued or overvalued opportunities and where some active managers can beat the index. Use passive investing for the asset classes, sectors, or regions that are more stable, and active investing for the ones that are more volatile. This means that you use passive investments for the markets that are more consistent, predictable, and resilient, such as the US bonds, where it is harder to time the market or predict the future, and where most active managers add little value. Then, you use active investments for the markets that are more inconsistent, unpredictable, and risky, such as the commodities, where it is easier to time the market or predict the future, and where some active managers can provide value. And that concludes our journey through the financial orchid of active and passive investing. If you enjoyed this video or found it informative, don't forget to hit the like button and subscribe for more finance wisdom. Feel free to share your thoughts in the comments below, and until then, happy investing.